In the unpredictable journey of life, financial emergencies can strike at any moment, whether it's a sudden medical expense, a major car repair, or unexpected job loss. These unforeseen events can wreak havoc on your finances if you're not prepared. This is where having an emergency fund becomes crucial. An emergency fund acts as a financial safety net, providing you with a cushion to navigate through tough times without derailing your long-term financial goals. In this comprehensive guide, we'll explore the importance of having an emergency fund and provide you with actionable steps to set up your first one. Understanding the importance of an emergency fund. Imagine this scenario. You wake up one morning to find your car won't start. After a visit to the mechanic, you're hit with a hefty repair bill that you hadn't budgeted for. Without an emergency fund, you might have to dip into your savings or, worse, rely on credit cards or loans to cover the expense. This not only adds financial stress, but can also lead to long-term debt. An emergency fund serves as a financial buffer against such unforeseen expenses. It provides peace of mind, knowing that you have a reserve to fall back on during times of crisis. Moreover, having an emergency fund can prevent you from derailing your progress towards other financial goals, such as saving for retirement or buying a home. Determining your emergency fund needs. The size of your emergency fund depends on various factors, including your monthly expenses, income stability, and individual circumstances. A common rule of thumb is to aim for enough savings to cover 3 to 6 months' worth of living expenses. However, this figure can vary based on your specific situation. Start by calculating your monthly expenses, including rent or mortgage, utilities, groceries, transportation, insurance premiums, and any other essential bills. Multiply this amount by the number of months you'd like to cover, e.g., 3 to 6 months, to determine your target savings goal. Keep in mind that if you have dependents or irregular income, you may want to aim for a larger emergency fund to provide additional security. 1. Set smaller savings goals. Start with setting smaller savings goals instead of one big one. This way, you won't feel overwhelmed right from the start. Instead of aiming for saving 3 months' worth of expenses straight away, try aiming for just 1 month or even 2 weeks. When you reach these smaller goals, it feels like a win and keeps you motivated to keep going. As you get into the habit of saving, you can start setting higher goals. By the time you're on your 3rd or 4th goal, saving will feel more natural and you'll have the momentum to tackle bigger ones. Breaking it down like this makes saving feel less scary and more manageable. Plus, it builds a positive attitude towards saving money, which sets you up for better financial stability in the future. 2. Start with small, regular contributions. Set your initial contribution level at a relatively small amount. That will ensure you don't stress your cash flow, making it too easy for you to rationalize abandoning your savings routine. Find something in your life you can live without or with less. Trim back the monthly coffee habit a bit. Pass on that new pair of shoes or one big night out. Choose that amount, whether it's $5 or $100, and commit to saving it at regular intervals, per month, per week, or per paycheck. The key is that it needs to become a habit, not a recurring struggle. 3. Automate your savings. Out of sight, out of mind. The easiest way to save money is never to touch it in the first place. Most employers provide direct deposit, and some will even deposit to more than one account. Set up a separate account just for your emergency fund and have your chosen contribution amount deposited automatically, either by your employer or your bank. Use a savings or other type of account that you can't access easily, unlike a checking account. Chances are you won't miss it. And don't watch the account balance continually. That will only make growth seem smaller and slower. Forget about it and let time do its thing. 4. Don't increase monthly spending or open new credit cards. Once saving has become automatic, don't be lulled into a false sense of financial security and let spending creep up again. For example, if you gave up a new pair of shoes every month only to replace it a couple of months later with a new monthly shopping habit, you're not saving at all. If you still have an extra $50 left over each month, maybe your savings deposit amount is too low. If you don't have an extra $50, you may be running up a credit card balance. Neither is productive. You shouldn't stop enjoying life while you build your emergency fund, but you shouldn't lose sight of its importance either. Having an adequate emergency fund is critical to your financial well-being. Be realistic, but try to reach your ultimate savings goal as fast as you can. That alone might make life more enjoyable. 5. Don't oversave. Or, more accurately, don't devote too much of your savings to your emergency fund. By definition, an emergency fund is cash you can access quickly. That means you are most likely storing it in a low-yield vehicle like a savings account that is earning an extremely low rate of interest. For that reason alone, you should stop contributing to that account once you've reached your ultimate goal. Start depositing into an account where it will start earning money on its own, ideally, your retirement accounts, where time will enable it to bear the most fruit. Choosing the right account. When establishing your emergency fund, selecting the appropriate account is crucial to optimize liquidity, safety, and potential returns. Several options are available, each with its own set of advantages. A high-yield savings account is an excellent choice as it offers a competitive interest rate while allowing easy access to your funds. Look for accounts with no monthly fees and ensure they are insured by either the FDIC or NCUA for added security. Money market accounts provide the liquidity of a savings account coupled with higher interest rates akin to certificates of deposit, CDs. These accounts often come with check-writing privileges and ATM access, offering added convenience for accessing your funds. Certificates of deposit, CDs, offer attractive interest rates compared to traditional savings accounts, but require locking in your funds for a specified term, which can range from a few months to several years. While CDs guarantee returns, they may not be the best option for emergency funds due to early withdrawal penalties. Cash management accounts, offered by some brokerage firms, provide a blend of checking and savings functionalities. These accounts often offer benefits such as ATM fee reimbursements and higher yields compared to traditional banks. When choosing an account for your emergency fund, prioritize finding a balance between accessibility, safety, and potential returns. Consider your risk tolerance and liquidity needs before making a decision. By selecting the right account, you can ensure that your emergency fund remains readily available while also earning a competitive return on your savings. Building an emergency fund is a critical component of sound financial planning. By establishing a financial safety net, you can protect yourself against unexpected expenses and weather financial storms with confidence. Whether you're just starting your journey to financial stability or looking to enhance your existing savings strategy, prioritizing the creation of an emergency fund is a wise investment in your future financial well-being. Start today and take the first step towards greater financial resilience and peace of mind. Your future self will thank you for it. Thank you for watching, and don't forget to like and subscribe for more videos.